Figma just dropped its first ever public earnings report. And get this, revenue surged, profits are up. So why did the stock absolutely plummet by nearly 20%? So what's going on? If you're in design, tech, or just love a good market mystery, you know Figma, the design powerhouse that went public with a bang. Their Q2 2025 earnings just came out, and while the numbers look good on the surface, Wall Street had a very different reaction. Today, we're diving deep into the market and why it freaked out, and what does this mean for Figma's future. The good news, Figma did have strong performance. Let's start with the good stuff. Figma absolutely crushed it on several fronts for Q2. They pulled in 249.6 million in revenue. That's a massive 41% jump year over year. They even beat analyst expectations. Not only that, they're now profitable, reporting a net income of over 28 million. And here's a stat that I love. Their net dollar retention rate was 129%. That means existing customers are not just sticking around, they're spending more money on Figma. Plus, they're growing their big enterprise clients like crazy. These are fantastic numbers for any company, let alone one off a fresh IPO. So with all that good news, you expect the stock to soar, right? Well, guess not. Figma's stock took nearly a 20% nosedive after the report. Why the massive disconnect? It boils down to one word: guidance. While their Q2 numbers were solid, their projections for the next quarter and the full year fell short of Wall Street's sky-high expectations. They're forecasting around 33% growth for Q3, down from the current 41%. For a company with such premium valuation, any sign of slowing growth, even from hyper growth to still incredible growth, is met with extreme prejudice. But it's not just about the numbers. Management also signaled that they're going to be making significant investments. We're talking big bucks into AI development and expanding their platform with cool new tools like Figma Make, Figma Draw, and Figma Sites. This is a smart long-term play, but it means near-term profits might be impacted, and that makes short-sighted investors nervous. And let's be honest, Figma's valuation after its IPO was near already stratospheric. The stock was trading at a very high price to sales ratio, leaving virtually no room for error. When you're valued that high, you don't just need to beat expectations, you need to shatter them. What's my take? Personally, I think this is a classic case of Wall Street short-term focus clashing with a company's long-term vision. Figma is still an absolute powerhouse. They have a dominant product, incredible user loyalty, and they're aggressively innovating, especially with AI. These investments they're making now are crucial to stay ahead of the curve and expanding their ecosystem. And temporary slowdown in growth from 41% to 33% isn't a death kill. It's a natural evolution for a rapidly scaling company. For long-term investors, this dip might actually represent an opportunity. The core business is incredibly strong, and they're planting seeds for massive future growth. Let's be honest, guys. 33% growth is still fantastic. Ultimately, Figma's Q2 earnings were a mixed bag of strong performance met with overly aggressive market expectations. The underlying business is robust. Their focus on innovation, particularly with AI, positions them well for the future. It's a reminder that even great companies can face market volatility, especially right after an IPO. What do you guys think? Let me know in the comments. I'm actually still very bullish on Figma. Their balance sheet is great. They're still growing great. I think this dip could be an actual opportunity, especially dollar cost averaging in for the future. Let me know what you guys think in the comments. Please like and subscribe if you got anything from this video. Thank you.